As of 9:55 a.m. Eastern Time on November 6th, shares of Beyond Meat, ticker BYND, are trading at $1.45 per share, representing a surge of 13.96% on the day. Now, looking at that chart, seeing that massive green candle, the immediate expectation is that the rally is back on. Anyone who watched this stock go from 50 cents to over $7 just a couple of weeks ago is likely seeing this 14% pop and thinking the short squeeze is igniting again. But the reality is that today's volatility is almost certainly a symptom of a company in deep fundamental distress. This isn't a signal of strength, it's the chaotic aftershock of a market event colliding with a disastrous fundamental update. The common belief, the one driving the volume, is that Beyond Meat is still that high-growth disruptor that IPO'd in 2019, a company that was supposed to change how we eat. The narrative on forums and social media has been that this is the next great comeback story, a heavily shorted stock ready to fly. The expectation is that this 14% jump is the precursor to another 1,000% run. The reality, however, is that this stock is flashing every warning sign in the book. The rally in October has all but evaporated, and the company's own management just handed investors the worst possible news they could, short of a bankruptcy filing. Let's be very clear about what is happening right now, because the action over the last 3 weeks tells the entire story. In late October, Beyond Meat suddenly became the new darling of the meme stock crowd. It was added to a popular meme ETF, and discussions on Reddit and X, formerly Twitter, exploded. The stock, which was trading near its all-time low of just 50 cents, went on an unbelievable parabolic run, hitting an intraday high of $7.69. The volume was astronomical, with hundreds of millions and at one point billions of shares changing hands. This was driven by a narrative of a massive short squeeze. Social media influencers and data accounts were circulating figures claiming the short interest on Beyond Meat was over 80%, some even claiming 100% of the free float. This created a classic feedback loop. The price rose, shorts who were trapped had to cover, and the buying frenzy from retail traders fed on itself. But here is the reality check that so many missed. That 80% short interest figure was by all accounts incorrect. It appears to have been based on outdated data that did not account for a massive, company-altering event, a debt-for-equity swap. In mid-October, Beyond Meat converted nearly $1.1 billion of its convertible notes into new shares. This single move massively diluted existing shareholders, quintupling the outstanding share count overnight. Many of the bondholders who received this new stock were likely shorting the stock as a hedge against their debt position. When they received their new shares, they simply used them to cover their short positions. This wasn't a squeeze in the traditional sense. It was a massive, planned dilution and a covering event by institutions, not a retail-led victory. This brings us to the short seller awareness that is critical for the stock. If you were looking at Beyond Meat, you need to know how to find the real data. You can go directly to the NASDAQ website or use terminals like Fintel to see the official bi-monthly short interest reports. As of the latest filings, the short interest is closer to 14 or 15% of the float. While that is still high, it is a universe away from the 80% or 100% figures that fueled the squeeze. Furthermore, we can look at the short borrow fee rate. This is the interest rate short sellers must pay to borrow shares. During the peak of the squeeze in late October, that rate spiked to over 46%. As of this week, it has collapsed back down to around 3 to 4%. This is a definitive signal that the intense pressure from short sellers has evaporated. The squeeze is over. What's your take on the social media data versus the official filings? Do you think the 80% short interest figure was an honest mistake or intentional manipulation? Now let's look at the other side of the short seller coin, the fails to deliver or FTDs. Data from the end of September showed a colossal spike in FTDs, with over 8.7 million shares failing to be delivered on time. This is a massive number for any stock and is often pointed to by retail investors as a sign of irregular trading activity or a backlog of short positions that cannot be covered. While the cause is debated, such a high FTD number absolutely contributed to the explosive, volatile environment that allowed the subsequent meme rally to happen. It created a powder keg that was just waiting for a spark. So, if the squeeze is over, why is the stock jumping 14% this morning? This is where the story turns from speculative to grim. This volatility is not a sign of health, it's a sign of panic and confusion. Earlier this week, on Monday, November 3rd, Beyond Meat shocked the market by announcing it was delaying its third-quarter earnings report, which was scheduled for November 4th. The company pushed the report to November 11th. The reason given is the absolute last thing any investor wants to hear. Management said it needed more time to finalize its assessment of a non-cash impairment charge related to its certain long-lived assets, and that this charge is expected to be material. In plain English, the company is telling the market that some of its factories, equipment, or other major assets are not worth what the company has been claiming they are worth on its balance sheet, and the write-down is going to be big. This news is a fundamental catastrophe. It implies that past investments have failed and that the company's operational footprint is too large for its collapsing sales. When this news hit, the stock plunged, falling from its post-rally stabilization of around $2 back down to the $1.20 to $1.30 range. This morning's 14% jump to $1.45 is a classic dead cat bounce. It's day traders and algorithms scalping pennies, and perhaps some remaining retail investors hoping for one last miracle, buying a dip that is really a chasm. The volume today, while high, is significantly lower than the average volume seen during the peak of the meme rally, suggesting the army of buyers has largely moved on. To add insult to injury, at least one major law firm has already announced an investigation into Beyond Meat for potential securities fraud, questioning whether management knew these assets were overvalued and failed to inform investors sooner. This is the central tension for Beyond Meat. The expectation, fueled by social media, is a high-growth tech company battling evil short sellers. The reality is that this is a low-margin food commodity business that is fighting for its very survival. Let's briefly rewind to what this company actually does. Beyond Meat was founded in 2009 and had a meteoric IPO in 2019. It was the poster child for the plant-based food movement, promising to deliver the taste and texture of animal-based meat without the environmental or health downsides. At its peak, the stock traded at nearly $240 per share. But the company failed to build a durable competitive advantage. The market was flooded with competitors, from Impossible Foods to legacy producers like Tyson and store brands from Kroger and others. Consumers began to realize that Beyond Meat's products were not necessarily healthier, were often highly processed, and most importantly, were expensive. The company's core problem is a complete lack of pricing power. It's selling a commodity in a crowded field. Its quarterly reports for the last 2 years have been a sea of red ink, showing collapsing revenues, shrinking margins which have sometimes been negative, meaning it costs them more to make the product than they sell it for, and mounting losses. The recent Q2 report was a disaster, with a 19.6% year-over-year revenue decrease. The company is burning through cash at an alarming rate. Recent data from August showed that the company's days beyond terms, how long it takes them to pay their own suppliers after the due date, had more than doubled to 19 days, a clear sign of a severe cash crunch. Wall Street has completely given up on the stock. According to analyst data, there is not a single buy rating on Beyond Meat. It is all holds and sells, with an average price target that suggests even the analysts were caught off guard by the recent meme rally, but their long-term outlook remains bearish. This leads us to the future outlook. The expectation of a new squeeze is colliding with the reality of a potential delisting or bankruptcy. The single most important date on the calendar is now November 11th. The entire market is waiting to find out the size of this material impairment. A massive write-down will further destroy its balance sheet. We will also see just how bad the revenue collapse was in Q3, and critically, what their cash burn looks like. Do they have enough cash to even make it through the next few quarters? The risks here are no longer theoretical. The primary risk is insolvency. The company is losing on all fronts: declining consumer demand, intense competition, no pricing power, and a balance sheet being hollowed out by debt and now asset impairments. The recent dilution, while it did clear some debt, flooded the market with shares, putting a permanent ceiling on any price recovery. The volatility is extreme, and any position, long or short, is fraught with risk. The stock is trading like a penny stock because fundamentally it is one. Comment below what you think Beyond Meat needs to do to actually turn its sales around. Ultimately, the story of Beyond Meat is a harsh lesson in expectation versus reality. The market, for a few weeks, expected a 2021-style short squeeze, ignoring the fundamentals. They were trading a ticker, a symbol of a past story. But the reality is that the company behind that ticker is in a fight for its life. The squeeze was an illusion, a technical anomaly created by a massive dilution event. The 14% pop today is not the start of a new rally, it's the last gasp of the old one, as the market struggles to price in the truly terrible news that the company itself has been forced to reveal.